Key person insurance. So key person insurance is usually for a business, and actually it's always for a business. And the way it works is that a company gets insurance on one of its employees to make sure if that employee dies, they have money to train a replacement and also replace any money that the company loses from that employee dying and not being able to generate revenue. So for example, let's just give here where we have, say someone is like the CFO of a company and they're in charge of the finances, and the company says, well, this employee essentially is responsible for $2 million of revenue generation for us in a year, and we would probably spend 3 months looking for a replacement, and we'd have to interview people and pay people to interview them and hire a recruiter and a headhunter and everything else. So they say, hey, well, in that 3 month time, it'd say it costs us $500,000 to hire someone between loss of revenue and who they have to hire, say, whatever, $500,000 between loss of revenue and who they have to hire to find that person in the interview process and everything else. So they would get a key person policy for $500,000 on the CFO so that when that employee dies, the company can replace that person and not really lose out on the money that that person would have been bringing into the company. So all a key person policy is, it's when a business owns a policy on one of its employees so that they can pay the bills of hiring someone new to replace that employee, and then also cover any lost revenue that that employee would have brought to the company. I hope this helps you pass your life insurance pre-licensing exam. Check out this next video coming up so that you can learn more helpful tips to help you pass your exam.